Maybe you missed the first wave of AI. You watched Nvidia Corporation surge more than 800%, and by the time you found out about ChatGPT, it had exploded into the mainstream, and most of the easy money was already gone. Early investors in semiconductor ETFs turned ordinary portfolios into serious wealth, while everyone else was still trying to figure out what was happening. Maybe you told yourself, next time, I'll get in earlier. Well, next time may already be here. Quantum computing is shaping up to be the biggest technological breakthrough since the internet, and the opportunity is still early enough for retail investors to position themselves before the crowd catches on. This isn't hype anymore. Governments are pouring billions into quantum research, and the global quantum computing market is projected to grow from $1.9 billion today to nearly $20 billion by 2035, a staggering 30% compounded annual growth rate. Meanwhile, most investors are still asking, what even is quantum computing? That question, and more importantly, its answer, could be worth a fortune to you. In this video, we're diving into the 3 best quantum computing ETFs and uncovering what sets each one apart. We'll break down their quantum exposure, growth potential, risk level, and why this technology could become far bigger than most investors realize. By the end, we'll demonstrate how a daily $10 investment in one of these ETFs can yield a whopping $12 million. And that will probably explain why the people getting in early today could look incredibly smart a decade from now. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. Firstly, let's discuss what quantum is and why classical computers are running out of road. Think of today's computers like incredibly fast librarians. They can search through massive libraries of information, but they still have to check one book at a time, one shelf at a time, moving step by step, no matter how powerful they become. For decades, that system worked beautifully. It gave us smartphones, streaming, AI, online banking, and practically the entire modern world. But now we're hitting problems that are simply too massive for traditional computers to handle efficiently. Imagine trying to predict every possible traffic pattern for millions of self-driving cars in real time, or designing a new cancer drug by simulating every molecular reaction inside the human body. A classical computer could spend thousands, even millions, of years crunching those possibilities. That's where quantum computing changes the game completely. Quantum computers don't think the way normal computers do. Instead of walking through one door at a time, they can explore countless doors simultaneously. It's less like solving a maze step by step and more like hovering above the maze and seeing every possible exit at once. That difference is enormous. Banks see quantum computing as the future of fraud detection and financial modeling. Pharmaceutical companies see it as a shortcut to discovering life-saving drugs. Governments see it as both an opportunity and a necessity because quantum machines could eventually crack today's encryption systems, which protect everything from military secrets to your online banking password. And then there's AI. The more advanced artificial intelligence becomes, the more computing power it demands. Quantum computing could become the engine that pushes AI into an entirely different league. This is why so much money is flooding into the space right now. Major corporations, governments, and research labs aren't investing billions for fun. They're racing because whoever leads quantum computing could shape the next era of technology, just like the companies that dominated the internet and smartphones transformed the last 2 decades. That's why quantum computing matters now more than ever. We're not just watching another tech trend. We're watching the early foundations of a completely new computing age take shape. Now, let's discuss the best strategy when trying to dive into a new fast-moving technology. Because here's the reality most new investors don't realize at first. Finding the next big technology trend is hard enough. Picking the one company that will dominate it is even harder. Think about the early days of smartphones. Everyone knew mobile technology was going to explode, but very few people correctly predicted every winner and loser. Some companies looked unstoppable and disappeared. Others came out of nowhere and became giants. Quantum computing feels very similar right now. That's why ETFs can be such a powerful strategy. In case this is your first time hearing the word ETF, it's simple. The word stands for Exchange Traded Fund, and one of the best ways to describe it is simply as a basket of companies bundled into a single investment. Instead of betting everything on one quantum computing stock, you spread your money across multiple companies working in the industry. If one struggles, another may thrive. You're investing in the growth of the entire sector instead of gambling on a single name. It's the investing equivalent of owning the whole gold rush instead of trying to guess which miner finds the biggest nugget. Even legendary investors like Warren Buffett have repeatedly recommended ETFs for everyday investors because diversification lowers risk while still allowing you to benefit from long-term market growth. Buffett has famously argued that most people are better off owning broad funds than trying to outsmart the market with stock picking. And when it comes to emerging technologies like quantum computing, that advice becomes even more important. Nobody knows with certainty which company will become the future leader of quantum computing. But if the industry itself explodes the way many analysts expect, a quantum computing ETF gives you exposure to the entire wave of innovation. That means you don't have to perfectly predict the winner to potentially benefit from the growth. In fast-moving sectors, sometimes the smartest move isn't picking the hero, it's owning the ecosystem. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. Now let's dive into the first ETF. If you want a quantum computing ETF with a real track record rather than just hype and headlines, the Defiant Quantum ETF, ticker symbol QTUM, immediately stands out. This isn't some brand new fund trying to capitalize on a trendy buzzword. QTUM launched back in 2018, long before quantum computing became a mainstream topic of conversation in investing. And since then, it has quietly built one of the strongest resumes in the entire space. Today, the fund manages more than $3.5 billion in assets, carries a 5-star Morningstar rating, and has delivered an average annual return of roughly 25% since inception. That kind of performance gets attention because it shows investors aren't just buying into a futuristic idea anymore. They're already putting serious money behind the technology. What makes QTUM especially attractive is how balanced the portfolio feels. The ETF tracks the Blue Star Quantum Computing and Machine Learning Index and holds 85 companies tied directly to quantum computing, artificial intelligence, semiconductors, machine learning, and advanced computing infrastructure. And with an expense ratio of only 0.4%, investors aren't paying outrageous fees just to gain exposure to the next generation of technology. Now, here's where things get interesting. QTUM gives you exposure to the exciting pure-play quantum companies that could potentially explode in value over the next decade. Companies like Quantum Emotion focus on quantum cybersecurity and random number generation, while Coherent Corp develops advanced photonics and laser systems critical to quantum hardware. Even Nokia is positioning itself in quantum-safe networking infrastructure, an area that could become incredibly important as cybersecurity evolves. But unlike throwing all your money into a single speculative startup, QTUM balances those high-growth names with established industry giants such as Micron Technology, Lockheed Martin, Northrop Grumman, and Lam Research. These are profitable companies with strong balance sheets, government contracts, and decades of operating history. They help stabilize the portfolio when smaller quantum stocks experience wild swings, which is almost guaranteed in an emerging industry like this. That balance is what makes QTUM feel less like a gamble and more like a strategic long-term investment in the future of computing itself. But here's the thing, QTUM isn't the only ETF trying to capitalize on the quantum revolution, and the next fund takes a very different approach that could offer even greater upside, along with much more volatility. If QTUM is the foundation, the WisdomTree Quantum Computing Fund, ticker symbol WQTM, is the accelerator. This is the ETF for investors who have high conviction in quantum computing and want the most direct, concentrated exposure the market currently offers. What makes WQTM genuinely different is how it was built. Developed in partnership with Classic, a recognized leader in quantum software, WQTM uses a proprietary framework that combines pure-play quantum pioneers with carefully selected global leaders. It's not just throwing tech stocks at a wall, it's a deliberate, intelligent construction of the quantum ecosystem from the inside out. The top 10 holdings tell that story clearly. EonQ leads the fund at 6.91%. Followed by Rigetti Computing at 5.56% and D-Wave Quantum at 5.08%. Quantum Computing Inc. comes in at 3.91%, with Intel rounding out the top 5 at 3.85%. From there, Amazon sits at 3.4%, Nokia at 3.14%, Advanced Micro Devices at 3.05%, Alphabet at 2.93%, and Nvidia at 2.85%. Together, those top 10 positions account for over 40% of the entire fund, and that concentration is exactly the point. Let's talk about those pure-play quantum names, because this is where WQTM separates itself from everything else. EonQ is the undisputed leader in trapped ion quantum computing, the architecture many experts believe will dominate long-term. Rigetti is building full-stack quantum systems and aggressively targeting cloud-based quantum services. D-Wave has already moved beyond theory. It's the first company to offer commercially available quantum computers, with real enterprise clients using its systems today. Quantum Computing Inc. is focused on making quantum accessible through software, bridging the gap between today's hardware and real-world business applications. These aren't companies waiting for the quantum future. They're building it right now. And then there's the stabilizing layer. Amazon, Alphabet, Nvidia, and Intel are not speculative plays. They are trillion-dollar companies with dedicated quantum research divisions, massive infrastructure, and the financial muscle to outlast any market downturn. When the pure-play names swing, and in an emerging sector like this, they will. These giants keep the fund grounded. Yes, WQTM is less than a year old, but in a sector this new, that's not a weakness, it's a feature. This fund was built for this moment, up 26% since launch and climbing. WQTM is the top pick for investors who want maximum quantum exposure backed by some of the most powerful companies on the planet. But here's what most investors completely overlook. None of this quantum revolution works without one critical piece of infrastructure. And there's a brand new ETF that's quietly positioning itself to own it. And the unique ETF is none other than the Roundhill Memory ETF, ticker symbol DRAM. Listen, every technological revolution runs on infrastructure that most investors completely overlook. When the internet boomed, the real fortunes weren't made in websites. They were made in fiber optics, server racks, and the hardware that made it all possible. In the AI and quantum era, that equivalent is memory, and DRAM is the purest, most direct play on that thesis available today. Launched on April 2, 2026, DRAM is the first and only ETF dedicated purely to memory chip manufacturers. The company's building the high-speed memory that powers AI data centers, large language models, and quantum computing infrastructure. It's actively managed with a 0.65% expense ratio, and it uses a proprietary selection process built on market share and revenue tied directly to the memory industry. The holdings are deliberately concentrated and unapologetically focused. SK Hynix leads the fund at roughly 26%, followed by Samsung Electronics at around 21%, and Micron Technology rounding out the dominant trio. Together, those three names control nearly 3/4 of the global memory market, and nearly 3/4 of this fund. From there, Kioxia Holdings comes in at around 6%, SanDisk at 5.4%, Seagate Technology at 5.3%, and Western Digital at just under 5%. Nanya and Winbond round out the remaining positions. Now let's talk about why these names matter so much. SK Hynix alone commands a staggering 57% of the global high-bandwidth memory market, the specialized memory chips that sit directly inside NVIDIA's AI accelerators. Without SK Hynix, the AI revolution slows down. Micron just reported 196% revenue growth in a single quarter. SanDisk followed with revenues up 251% year over year. These aren't growth stocks with promise, they're growth stocks with receipts. And here's what makes DRAM so compelling as part of a broader quantum and AI portfolio. It fills a gap that QTUM and WQTM simply don't. Neither of those ETFs gives you meaningful concentrated exposure to the memory layer. Every quantum computing breakthrough, every new AI model, every expanding data center demands more high-speed memory. That demand isn't cyclical, it's structural. And some industry insiders believe the supply bottleneck could last well into 2030. DRAM is up roughly over 68% since launch in just weeks. That's not noise. That's the market finally waking up to the fact that the picks and shovels of the AI and quantum gold rush aren't just chips, they're memory. As promised at the beginning of this video, it's time to dive into the numbers. Let's put the power of consistency into perspective. Imagine Bobby investing just $10 a day into QTUM, about the price of a coffee and a cookie. It sounds small, almost forgettable. But in the world of long-term investing, small daily habits can quietly turn into life-changing wealth. To keep things realistic, we'll look at two scenarios, one based on a more conservative estimate, and the second will be demonstrated using QTUM's current average annual return. For the conservative scenario, we'll be using a 15% average annual return, which is still incredibly strong by long-term investing standards. Even at this lower growth rate, the results are enough to completely reshape Bobby's financial future. With just $10 invested daily into QTUM, by the 10-year mark, Bobby's portfolio could grow to approximately $52,000. That's the stage where Bobby begins realizing that consistency matters far more than trying to perfectly time the market. By year 20, the account could reach nearly $265,000. At this point, growth would start accelerating in a way that feels almost unreal, as compounding begins to do the heavy lifting. And then comes the long-term payoff. After 30 years, Bobby's portfolio could potentially grow to around $1.2 million, all from investing the equivalent of a small daily expense. That means a total investment of about $109,500 over 3 decades could still turn into millionaire-level wealth. I know this is fantastic, but let's check out what Bobby's portfolio could look like using QTUM's current average annual return of 25%. At the 10-year mark, Bobby's portfolio could grow to roughly $121,000. That's the moment where investing stops feeling like a side habit and starts feeling like a serious financial engine. By year 20, the portfolio could climb past $1.25 million. At that point, the conversation changes completely because Bobby is no longer just saving money. The money is now working harder than he is. And here's where things become truly eye-opening. By year 30, that same $10 a day could potentially grow to just under $12 million. On a total contribution of only $109,500 over 3 decades, that's an astonishing 107-to-1 return. Suddenly, skipping one expensive habit a day doesn't seem so small after all. And that's the real lesson here. You don't necessarily need perfect timing, a massive paycheck, or lottery-level luck. Sometimes, a simple daily habit combined with patience can quietly build extraordinary wealth in the background. You definitely do not want to watch this opportunity from the sidelines. So, please let me know your plans in the comments below. Now, if today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Listen, if you want to know the 3 best ETFs you can invest in to participate in the $2 trillion SpaceX IPO or the $49 weekly ETF strategy that yields $6,000 monthly income, click on the video on your screen right now. Thank you, my friend.